Hi, I'm Peter Rose, founder of Longwood Currency Trading. Can you grow a small account into a big account? The answer is yes. Now, you might have inferred from a lot of the videos that I've done in the past, there's almost 300 of them now at this particular date, we're mid-March of 2023, that I say that you can't. Well, you can, of course you can, because there's lots of people that do that. The question becomes a little faded when you start saying, well, what constitutes a small account, and can you grow it large? What's the definition of large in relationship to small? And what are the mechanics that you're going to use in order to go about that? The problem with trying to grow a small account into a large account is that if you're not disciplined and understand or have been taught the proper methodology of trading itself, then what's going to happen is you're going to be trading for the money to make more money in doing that small account than you are in trading correctly. There's a lot of folks that are doing small to large account trading, and they're just taking way too much risk in order to make more dollars. If you're trading with a mini lot, for example, some of the major currency pairs now will require about $600 a margin, $500 a margin, US, okay? If you're trading 200 to 1 or you don't have any margin requirements, your government that you're trading under doesn't have any regard for you as a speculator or a trader, and they're going to let you do stupid shit, and you're going to go broke. So if you bring things down to proper leveraging and proper margin, you'll be much more capable of doing not only working with small accounts, but also working with the larger accounts as well. That's part of your risk management. And I think a lot of folks overlook that as part of their trading plan. At issue is that when I say that you're not trying to make a lot of money, it means that you're not trying to take a mini account at $1 a pip and make 30 pips a day or 100 pips a day. If you could make 5 pips a day, that's $5 a day on a mini account. That's 0.5% on a $1,000 bank. Because in real risk management considerations, you always want to have more money than what your current margin is. At least double that. And I just have a concrete rule that if I'm going to trade one mini account, I need $1,000. If I'm going to trade one full account at $10 a pip, I need $10,000. So if we're going to trade 10 pips, I need $100,000. If you're going to trade one mini, you need $1,000. What's a small account? To me, it's $1,000. Not $300 or $500 or any of that stuff. If you don't have $1,000, then you should not be trading in the currency markets. Because anything less than 1,000, you will be trading for the money. You can't help yourself, and you'll be pushing the envelope on things. You'll be compounding, you'll be doing staging, you'll be doing all kinds of stuff that's advanced stuff. And eventually, it'll catch up to you. You'll take that $300 and you'll run that to $3,000. You'll think you're a friggin' hero, and all of a sudden you'll lose $3,000. So that's just the way that it is, because you build bad habits. When I work with somebody, the mandate is I will work with you as long as you have followed best practices and learn how to trade. If you want to cowboy around, I'm not going to work with you. And that's part of the agreement that we have when we do consulting, is this is a methodology for you, and if you want to study under me, you follow that methodology. Don't try to make it up on your own. If you want to make it up on your own, don't include me in it, because I don't have time for that. I don't want to work with a whole lot of people. I want to work in depth with a few people. That's all I want to do, because I'm not selling classes and training and all that stuff. I'm retired. I've got plenty of stuff in my life I want to do. than to sit on the phone and talk with people in conferencing and mentoring that don't really want to do the work, or that are trying to do the wrong thing at the wrong time. So a small account to me is $1,000, and you're going to trade one mini at a buck a pip. That's it. You're not going to break those up into micro lots and all that other crap. It's one mini. Will you be compounding? Yes. If you could put $2,000 in your account, you could trade two minis. If you could put $3,000 in your account, you could trade three minis. It's all going up in equal increments. One of the reasons that I do the equal increment increasing in lot size is because when it comes time to do your trading metrics, it has to be based on some kind of a stable environment that the metrics are coming out of. You can't trade three minis one time on a, well, I should have a $3,000 bank on a $2,000 bank, and then trade three minis on a $5,000 bank, and then trade three minis on a $700 bank. You can't, or trade two minis and three micros. You can't develop good metrics that way. You could, but the math and the time that you'd have to put into doing all those calculations is time you should be spending better learning how to trade than farting around with that stuff. I was trying to make things easy. I don't like to work hard. I learned very early on, not only in my study of karate, which if you do things the hard way and you try to push things around too much, you don't develop the power that you could develop if you followed a certain pattern. And doing real estate is the same way. I spent 40 years as a real estate investor. I spent 33 years as a senior software engineer designing complex business applications, enterprise-level business applications. All of these things are done in an orderly fashion with certain rules that develop consistent application of those rules such that the metrics that come out of that are helpful for you in determining where you are in your skill level. Okay? Win-to-loss ratio is a very good example of a trading metric that you need consistent background data in order to be able to say, oh yeah, I'm consistently at that 60-40 level, or whatever it is that you're at. So there's one of the parameters. You're going to trade $1,000 and you're going to trade one mini. Are you going to stage those into micros? No, you're not going to do that. You're not going to compound that. The only way you're going to compound that is to have $2,000 in your bank, and then you could trade two mini lots, or $20,000 in your bank, and then you could trade two full lots. But we're talking about small accounts here. And again, if you don't have $1,000, just shut the channel off and don't, because I get hostile at people that are taking $300 accounts and building them up to $2,000 or $3,000. So what? Is $3,000 going to affect you in your life? Are you that poor off that you're going to take $300 and run it to $3,000? That's going to change your life? And do you really think you're going to be able to take, with those luck events that caused you to be able to go 300 to 3,000, are you going to be able to take the 3,000 and go to, well, it's a 10x, right? So figure it out, 3,000 to whatever that number is. I just don't think that's reasonable. Because unless you build good habits, you won't be able to trade the larger size accounts. Well, where am I going to come up with $30,000 for trade three lots so I can make $15,000 a year, $20,000 a year off that 30? Sell your truck. I don't know what you're going to do. That's your problem. I can teach you how to trade the money. I could help you with how to do that because I've done that kind of mentoring and stuff for folks for about 40 years. But that's not part of the game. The issue is, what do you do with the money that you have available to you? If you don't have at least $1,000, you don't have to worry about it because you shouldn't be trading currencies. Don't listen to me and don't send me an email. If you've got the $1,000, now what do? That's a small account. How do you make it a big account? Well, what's a big account? Well, would it be feasible to make 100% and go from a $1,000 level to a $2,000 level in trading? That's possible. Not in 3 months, not in 6 months, not in a year, particularly when you're beginning. It might take you 3 years to go from 1,000 to 2,000. But that's okay, because you're not going to be trading the $1,000 account for 3 years. You're going to trade the $1,000 account until you develop consistent and solid rules that produce consistent and solid trading metrics, and then you can trade one full lot. Put $10,000 in and trade one full lot, $10 a pip. And then you're going to rinse and repeat. You're going to do the same thing that you did with that $1,000 account trading one mini. You're going to do that with a $10,000 account trading one full lot. So when I do my examples, I'm always using at least one full lot to talk about that, because the loss of 10 pips is $100 on a full lot. That's going to crack you wide open. Is the loss of 10 pips on a mini lot, which is going to be $10, that's not going to crack you open. But if you get used to trading at that one mini lot position, that $10 loss, that's half a pizza, a couple of beers anyway. You don't want to lose that. The reason that trading the smaller lot levels is easier, or the smaller account size lot levels is easier than trading the larger size, is because your emotions don't get in the way in cutting the trade short at 10 pips, for example. As a lot of people say, oh, 10 pips, you got to let your trade run. Really? How far? 20 pips, 50 pips? How long are you going to let it run? If you're a 60-40 trader, do the math on letting a position run 20 pips against you and you taking your profits at 12 as a 60-40 trader. You do the math. It ain't going to work. It works a little bit at 60-40 if you take a 10 pip loss and you make 10 pips on the gain, because you're 60 to the good and 40 to the good. You're 20% to the good over 10 trades or 100 trades or whatever. So the loss in the smaller account sizes, $10, $30 or whatever, isn't going to not allow you to pay your light bill or your mortgage that month. And so you're more likely at that 10 pip stop to set that 10 pip stop and take that $10 loss. Then you look at the situation, you look at the entry analysis that you did and say, well, I screwed that up, it went against me. Well, why? Because you were too soon. You got in too soon. It didn't prove itself out. That's one thing. The other thing that happens a lot is you get hit with that 10 pip stop, you lose the 10 pips, and it turns around and goes in your favor. And you go, oh, that's a bad habit, to go, oh. Because the next time it goes, you're not going to take the 10 pip stop. You're going to, well, I'll give it 20 pips. And it'll go to 20 pips, and it'll hit you. When you start varying your risk, which is the only thing you have control of, you have invalid metrics. So these guys that are talking about risk to reward ratios and their risks and their rewards are changing all the time does not enable you to develop standardized metrics that will help you trade. Look, you have to learn how to trade first. And you're not going to do that by listening to these guys using indicators and compounding and all the other stuff that goes on, because that's not trading. And a lot of that stuff isn't applicable to the currency market anyway. They don't know that because they come out of the stock market. Currency trading is different because it's done for a different reason. The foundation of the currency market is based on something totally different. And so you have to have tools that facilitate the analysis of that market. So, first of all, you have to learn, well, what are the metrics that are going to be important to you? And then you'll see, when you understand what constitutes that metric, you'll understand better why you need to have consistency in some of the parameters of your trading. If you do that, and you trade that $1,000 account, and you're a 60-40 trader, hey, let's just go, you got $1,000, and you're going to make an average, not average win value, but your per trade expectation value, let's say, is 5 pips, which means that every trade that you make is worth 5 pips. So when you lose 10 pips, but when you win, you might win 15. So you cancel those two out, and you've got a 5 pip average position over that time frame. That's another metric that you follow. So how many days a week are you going to trade? I mean, those are all variables that you really vary. Sometimes there won't be a day to trade. So you have to work on averages. It's really hard to do that when you don't see yourself accumulating dollars and money to get frustrated and push the envelope too soon, either because it's not really time in the market to do that, or because you don't have the skill to take advantage of that move that's going on in the market. And so you have to be reasonable about what your let's look at a yearly gain on a $1,000 account. What's reasonable? Well, if you're just getting started, if you could make 20% on that money, you'd be doing great. You'd be doing better than anybody else in any other investment vehicle that's out there. 20%. Where are you going to get 20% on your money? Where today are you going to get 10%? You're not. Well, you could, if you pick the right stock out of the 6,000 that are out there, and it goes up 2% a day or 3% a day, you could make that in a month. But over the long run, the market was down 350 points yesterday. What do you want to do? You want to be on a stock that contributes to that and loses 8% of its value? I just because that market doesn't make any sense. There's too many variables involved in looking at it. You have fundamentals, emotional. You have crazy people running around line and all the other crap that goes with it. That's not the case in the currency market, is it? It's too big. It's almost $7 trillion a day. And mom and pop aren't just making the decisions on what's going on, because less than 15% of the total currency market on a dollar value base is retail traders. The rest are institutional traders trading for economies, swapping goods and materials between two economies. They know what they're doing, and they have a purpose for that, and so you don't have to worry about all the shit in the stock markets and stuff. So you don't have to react crazy in the currency market to make a solid return. But let's say you could make 10% on your money. You get $1,000, you make $100 for the year. Whoopee! Well, if you're trading a $100,000 account, you'd make $10,000 a year, which would be pretty good. 10% on a $100,000 account, trade 10 full lots. Is 10% all you can expect to make? No, but 10% on a $10,000 account is $1,000. That'll pay for your electric bill. And that's really the first step in your trading journey that you want to try to strive for, just to pay your electric bill. Don't worry about making $1 million or replacing your job income. Just be consistent at making your light bill. because that will prove out the work that you did in trading the mini account for $1 a pip. You're not going to pay your light bill on a monthly basis on a $1,000 account. You get about 150 pips that you'd have to make over the course of the month. So, if it was $160, it'd be 160 pips that you got to make. It'd be 40 pips a week. You're going to be able to do that? If you don't have the experience, probably not. But if you could just pick away and make an average of 3 pips a day, $3 a day, and develop that habit, then when you get up to the point where you're trading 3 full lots at $30,000, 3 pips is going to be $90, almost $100 a day. $100 a day. Oh, $100 a day. If you could do that, is $500 a week, right? And that's about $30,000 a year. To $25,000 a year or something, right? If you trade all the way through. So these little pip values are not really hard to achieve. It's just that you have to have the right mindset in order to do that instead of chasing the long ball, instead of swinging for the fence. I swing for the fence because I've got a 6-figure account and I'm not trying to pay my light bill and I'm not trying to replace my job income or enhance it. I'm trying to make $1 million the same way that I made it in real estate. So I'm trading for a different purpose, but I'm using the same skill sets that I base. It's just that when it goes wrong, it goes horribly wrong because I'm pushing it all to the center of the table. And if it goes slightly against me, it's $10,000, $20,000, just like that. Or I could manage that and just take the loss as maybe $1,000. And then on the upside, maybe I make 20 pips. So I make, I don't know, $4,000 or something like that. So you can have a large account and trade the same way that you're trading when you have a mini account and make 3 pips a day on a $100,000 account. You're making $300 a day with relative assurance that even at 60-40, you're going to do fine. But if you're 60-40 by farting around and not following the rules because you're trying to make money, that won't be successful for you. If you're making 3 pips every time you trade, so you trade five days for the week, you make 15 pips. You trade 3 days a week, you make 9 pips. It just depends on when you trade. But when you trade, and I'm just figuring on one trade a day. You could trade 5 times a day and do in a week. You could do what you would do in maybe 3 months. But we don't put that factor in. We're talking about one trade a day, so that you're not sitting in front of your computer for all day long waiting for all this shit to happen 2 or 3 times. So you got to be really, really careful about how you do your entry analysis and your position management and your ability to execute your exit methodology cleanly if you're only making that 1 trade a day. You can focus on that 1 trade a day. And if that thing goes against you, you just get out. And you come back and you fight another day. So what if you traded that way, what could you do? Well, I was trading that way last year, 2021, year before last, 2021, trading 1 to 3 lots, and I was up 60% on my money until later in the year, and then I was getting ready to move up in lot size, and so I tested that by going in really heavy, and I lost. And that one trade, it took me way back. But I made 31% on my risk for the year. Did pretty good. The next year, 2022, last year, I was up 90% right at the end of the year. And then I've told this story many times. I had started out trading 3 lots, and then I moved to 6, trading 8 to 10, finally moved up where I was trading 25 lot positions, 20 and 25 lot positions at the end of the year. The last 2 months of the year, I was trading 20 lot positions, 15 to 25 lot positions. And so I was up 91% on that risk as it was escalating up on the average risk that I had put in. And then again, pushed it to the center of the table. It was too late in the year. I had to get out of the loss position as a loss at the end of the year for tax purposes this time because the dollar amount was really big. I still made 46% on my money. But that's just pushing it and pushing it. So when I'm not pushing it, I'm following those basic rules. I'm just picking away at it. So there were 3 months last year where I had $30,000 months. Those were push months. There were 7 other, 7, 8, 9, 7. There were 6 other months where I was just picking away. And so, though I made the bulk of those funds in those 3 $30,000 months, I was doing 4 to 12% a month on my risk for those other months. So what can you expect? Well, 4% a month is going to give you 40%. You trade 10 months of the year, right? Instead of 12. Give yourself a couple of months off. So 40, 60% return on your money for the risks that you're taking, that's pretty reasonable. And it's reasonable because you're in and out, and you can trade every day. You know, in real estate, I averaged over 20% a year, and that was compounding as well, 25% a year, something like that. But man, I'd get into a trade, a building, and I very rarely sold a building. In the beginning, when I was getting started, I was using that money to roll into another building or another 2 buildings or whatever. But after I started buying 4-unit buildings, I held some of those for 20 years. So in that instance, I'm not getting in and getting out. I don't have the flexibility that we have in currency trading. That's why I'm trading currencies now instead of trading real estate. That's why I like the currency market. If things going really bad against me, I can get out. Sometimes I don't get out because I'm so ingrained in that real estate mentality. It's very hard for me to cut a loser. And if I don't set a stop because I'm trading a lot, taking a lot of in and out positions, you know, I'll just let it sit there, and all of a sudden I'm, $20,000 down. I go, eventually I'll be right, and it goes $40,000 against me, and then turns around and comes back, and I make $4,000. And was the amount of money that I made proportionate to the risk and the losses that I had suffered interim? Well, you could say no, but I still made $4,000. So, and on the risk that I was taking, that might be a decent percentage gain on the actual risk itself, negating how far it went out of the money. Well, last year I got caught where I took a huge loss, and it whacked 50% of my over 50% of my gain off the top, gone. But I'm still ending up with 46%. And that was because during the interim, when there isn't anything to push at, I'm using the same skills that I developed trading mini lots and single full lots or 1 to 3 lot position sizes. So can you take a small account and make a large account? Yes. What would the large account on $1,000 be? Call it 40%. So I'm going to make $400. I'll make $400 on the 1,000. I'll make $4,000 on the $10,000 account. I'll make $40,000 on $100,000 trading 10 full lots. How are we doing? If you had $100,000, you make 40% on it, that's $40,000. Are you making $40,000 at your job? You say, well, where am I going to come up with $100,000? That's your problem. What are you going to do? Are you going to cry and whine? Oh, I really want to drive a Lamborghini. We'll go buy one. Oh, I don't have the money. Well, don't cry about it then. Drive a Kia or something until you get the money to buy a Lambo. And by the time you get the money to buy a Lambo, if you make the decision to buy the Lambo, you're just stupid. All these guys, they don't own the Lambos. They rent them. Rent a Lambo for a couple of $1,000s a month. And then you drive around flashy and pretend that you own it. You don't own it. They say that it's good for business purposes because they can do a write-off against it. Yeah. But why write it off? Why would you write off a depreciating asset? Now, some of those high-end cars are appreciating. But if you're buying the low-end ones and you're buying them used, the money that you put into it, just to do a tune-up, is going to cost you $600. Put a new run of tires on it, cost you $10,000. So, just be realistic about what you're spending your money on. Put that money back into your account. That's a good way to make it a big account. Could you take $1,000 and make 40%? $400? Yeah, you could do that. If you know what you're doing. If you don't know what you're doing, how about settle it for 10% or 20%? And then, as you improve your skill level, taking the stop, you'll become a 70-30 trader. Or maybe 65-25 or something like that. Or 35. That changes the end dollar amount that you end up with. There are all kinds of ways that you can increase the dollars that you're making, but first of all, you got to learn how to stay in the positive realm of the world. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.